If I told you to picture a multi-billion-dollar tech firm using AI, autonomous robots, and like subterranean water lasers to capitalize on trillion-dollar government spending bills.
You definitely wouldn't picture the bright red lawnmower sitting in your garage.
Right, you absolutely wouldn't. But you really should.
Yeah, because the corporate landscape right now is, it's completely deceptive if you're just judging a business by its legacy consumer branding.
It's the absolute definition of hiding in plain sight. Welcome to the Deep Dive. Today we're analyzing what is honestly a masterclass in corporate repositioning.
We really are. We're looking at the Toro company's Q2 fiscal 2026 earnings release and their investor presentation, which is dated June 4th, 2026.
Exactly. And the goal for you, the listener, is to discover how a 110-plus-year-old company is quietly operating as this high-tech infrastructure and Gulf juggernaut.
All while just, crushing some pretty significant economic headwinds.
Okay, let's unpack this. Because thinking of Toro as just a lawnmower company is like finding out your reliable neighborhood baker also runs a multinational logistics empire on the side.
That's a great way to put it. And the financials from this Q2 2026 report, they completely back up that analogy.
They really defy the typical hardware manufacturing narrative we're seeing right now.
Oh, absolutely. I mean, we're looking at net sales jumping 8.1% year over year to $1.42 billion.
Wow. Over $1.4 billion.
Yeah, and their adjusted EPS was up 12.7% to $1.60. They even raised their full-year guidance.
Which is wild. They raised their full-year net sales growth expectations to a range of like 4 to 6.5% alongside a bump in the adjusted EPS guidance.
Right, and we have to view this through the lens of the current macro environment.
Yeah, because it's a landscape categorized by persistent inflation, supply chain gridlock, and really cautious consumer spending.
Exactly, yet their growth is actually accelerating, so we really need to look at the mechanics of how they're pulling this off.
So where do we start?
Well, the first step in understanding their execution is shattering the illusion of who their primary customer actually is.
Right, because when the average person hears the name Toro, they picture, the weekend warrior pushing a mower across a quarter-acre lot.
Exactly, but examining their product portfolio reveals a completely different reality. Only about 33% of their total products are sold to residential homeowners.
Wait, only a third?
Yeah, just a third. The absolute financial engine of this company, like the segment really carrying the weight, is their professional segment.
And the Q2 data shows that. That professional segment makes up a massive 70% of total net sales.
Right. That's $1.106 billion in a single quarter.
Which is up 9.1% from the previous year. But I actually want to push back on this split for a second.
Okay, go for it.
Well, grass is grass, right? Whether it's growing in a suburban backyard, a municipal park, or like a corporate campus, a mower is ultimately performing the same basic function. So why does this 70-30 split between professional and residential matter so fundamentally to investors?
It's a fair question. The distinction matters because of the underlying business mechanics, specifically margin expansion and predictability.
Okay, break that down for me. Let's look at the margins.
Historically, professional equipment for Toro runs at nearly twice the operating margin of residential. We're talking 18.5% versus roughly 10%.
Wow, that is a massive spread for products that, essentially do the same job.
It is, and it comes down to the engineering and the service ecosystem. Professional equipment utilizes heavier gauge steel, precision commercial hydraulics, proprietary drivetrains.
So they're built like tanks.
Basically, yeah. And these machines command a premium upfront price. But more importantly, they lock the commercial landscaper into a proprietary parts and service ecosystem.
Ah, I see. So when a municipal zero-turn mower goes down, the city isn't buying aftermarket parts at a big box store.
Exactly. They're going through the authorized dealer network, which generates high-margin, recurring revenue for the manufacturer.
That makes total sense. And we also have to factor in the replacement cycles, right?
Oh, definitely. If you ask the average homeowner how long they keep a push mower, the answer is usually, a decade, assuming they occasionally remember to change the oil.
Yeah, guilty as charged right here.
Right. And that is the exact problem with consumer hardware. The residential replacement cycle is highly unpredictable.
It stretches anywhere from 7 to 10 years.
But commercial landscape contractors are running these machines for thousands of hours under really brutal conditions.
So their equipment degrades much faster.
On a highly predictable 3 to 5 year timeline. And for golf course fleets on municipal or private club leases, The cycle is rigidly set at 3 to 4 years.
So Toro isn't waiting around for a homeowner's engine to seize up. They have this built-in calendar of professional fleet upgrades dictated by corporate budgets.
Exactly. It transforms intermittent hardware sales into something resembling recurring revenue.
That's brilliant. But looking at the sources, we shouldn't completely dismiss the residential side, should we?
No, not at all. Even that 30% piece of the pie had a stellar quarter. Net sales were up 4.4% to $310.4 million.
The revenue bump is solid, but the profitability metric is what really stands out to me in the residential data.
Right, the margins, their residential earnings margins jumped from 5.4% in the prior year period to 9.8%.
They nearly doubled their residential margin in a single year, and they did it despite a notable drop in snow product shipments.
Yeah, that's the crazy part. They own BAW SS snowplows, they manufacture snowblowers, so when the winter is mild, that entire product line basically stagnates.
Exactly. So how do they force that margin expansion when the weather actively worked against them?
They executed a strategy built around what they call Pro DNA.
Pro DNA. Okay, what is that?
They essentially took the commercial-grade features from their high-margin professional line heavy-duty fabricated decks, advanced suspension systems, and integrated them into premium residential zero-turn mowers.
So by elevating the consumer product, they gain immense pricing power.
Exactly. Combined with smart pricing and manufacturing productivity improvements, they proved they can squeeze significant profit out of the residential segment without relying on, weather-dependent volume.
And that manufacturing productivity aspect brings us to a really critical threat outlined in the Q2 materials.
Yes, the tariff issue.
Right. The sources flag an estimated fiscal 2026 gross tariff headwind of about $120 million.
Which is huge.
It's massive.
Mm-hmm.
For a company heavily reliant on raw materials like steel, aluminum, and electronics, a $120 million import tax is like starting a marathon with a 50-pound weight vest.
Yeah, it really is.
How does a manufacturing company just absorb that?
Well, what's fascinating here is that they didn't just absorb it, they mitigated the tariff impact dollar for dollar.
Wait, completely? How?
Through a largely U.S.-based manufacturing footprint and their aggressive utilization of USMCA qualifications.
The United States-Mexico-Canada Agreement.
Exactly. Under that agreement, products that meet specific domestic value thresholds can move across North American borders tariff-free.
So while competitors are exposed to the open ocean of global shipping and tariffs, Toro essentially built a closed-loop moat around North America.
That's a perfect way to describe it. They meticulously source their steel from within this trade bloc and deliberately maintain minimal exposure to the Chinese supply chain.
That completely insulates their cost of goods sold from trans-Pacific trade disputes. That's really smart.
And to further protect those margins, the presentation details an internal initiative called AMP.
Right, AMP. Amplifying maximum productivity.
Originally, AMP was projected to deliver $100 million in cost savings, but in this report, they increased the fiscal 26 goal to over $125 million.
With $105 million in annualized savings already implemented, I really want to drill down into the mechanics here.
Let's do it.
How does a legacy manufacturer physically extract $105 million in savings from an already mature production process?
The AMP savings are primarily driven by two things: design to value and supply-based transformation.
Okay, so design to value, that's an engineering philosophy, right?
Yeah. Instead of a mower deck requiring 15 different proprietary fasteners, engineers redesigned the chassis to use just 3 standardized bolt types across the entire product line.
Oh, wow. And they're also consolidating multi-piece stamped metal assemblies into single cast components.
Exactly. And doing that massively reduces assembly line time, shrinks warehouse inventory overhead, and it simplifies the whole warranty repair process.
And the supply-based transformation operates on a similar principle of consolidation, I imagine.
Right. If you're buying electronics from 50 different regional vendors, you have zero leverage.
But by consolidating that down to 5 global partners, they force volume discounts.
And secure priority allocation during supply chain crunches, these combined efficiencies are just generating incredible liquidity.
Which is so clear in the sources. They highlight a 124.5% free cash flow conversion rate for the first 6 months of the fiscal year.
That conversion rate is a phenomenal indicator of operational health.
It really is. And for you listening, a company converting more than 100% of its net income into free cash flow requires really aggressive working capital management.
It means they aren't just booking paper profits.
Exactly. They are actively shrinking their physical inventory, extending payables, and collecting cash from dealers faster. They are a cash-generating machine right now.
Which brings us to the most surprising detail in the sources, what they are actually doing with that cash.
Yeah, beyond returning $228 million to shareholders, they went underground.
Literally. They deployed that capital into an acquisition that seems completely un-Toro-like, tornado infrastructure equipment.
Right. And I have to ask you, the listener, directly. When you think of Toro, do you think of high-pressure vacuum excavation trucks? Probably not.
No, nobody does. When you review the product catalog for Tornado, you are looking at heavy-duty hydro excavation and vacuum trucks. It is highly specialized equipment.
Explain the core function of a vacuum excavator for us. Why do they need this?
Well, if a utility contractor needs to repair a buried municipal water main or lay a new fiber optic cable line, using a traditional backhoe is a massive liability.
Right, because one wrong scoop can sever a critical data cable or rupture a gas line.
Exactly. Tornado's trucks utilize non-destructive digging. They shoot highly pressurized water or air into the ground to pulverize the soil, and a massive industrial vacuum simultaneously extracts the slurry.
It acts like a surgical tool for the earth, safely excavating around delicate pre-existing infrastructure. This is a brilliant macro hedge, but I do have to challenge the integration strategy here.
Okay, what's your concern?
Selling a $3,000 zero-turn mower to a regional landscaping company requires a completely different sales channel than selling a $300,000 hydro excavation truck.
Oh, absolutely.
So how does Toro integrate this acquisition without blowing up their overhead trying to build a new dealer network from scratch?
Well, if we connect this to their historical acquisitions, the broader context becomes clear. This isn't random. Toro already owns Ditch Witch.
Ditch Witch, okay.
Yeah, which is the premier brand for heavy-duty trenchers and horizontal directional drills. Ditch Witch already has a sprawling, deeply entrenched global dealer network.
Oh, I see. A network that caters exclusively to heavy infrastructure and utility contractors.
Exactly. Toro doesn't need to build a new pipeline for Tornado. They simply slide the vacuum trucks into the existing Ditch Witch dealership ecosystem.
So they immediately offer a comprehensive end-to-end underground construction lineup to their existing buyers.
Right. And the timing is highly calculated.
Yeah, they're positioning themselves to profit from unprecedented global government infrastructure funding.
Multi-year spending booms, broadband rollout, electric grid modernization, water quality improvement.
And don't forget the massive subterranean power requirements for new AI data centers.
Oh, yeah. They've essentially built a subterranean hedge against bad weather and slow housing starts. Diversifying their end markets creates a durable fortress.
If consumers stop buying snowblowers because of a mild winter, the underground construction segment keeps the revenue flowing. But ironically, their biggest growth engine above ground is proving to be just as weather resilient, but for entirely different reasons.
Right, let's transition back above ground to where Toro dominates globally. Golf.
The macro environment outlined in the sources for golf is just staggering.
It really is. 2025 set a record for the most U.S. rounds played in a single year, hitting 549 million rounds.
549 million. And on-course participation has swelled to 29.1 million people.
It's a generational boom, and Toro is sitting directly at the center of it with the #1 global market share for golf course maintenance equipment.
And the sheer volume of foot traffic on these courses means they have to replace equipment much faster just to keep the greens playable.
Exactly, but it's not your grandfather's golf course maintenance anymore.
Here's where it gets really interesting. To maintain that market dominance, Toro isn't just making sharper blades, they are a tech company.
They are heavily pushing autonomous solutions for golf course superintendents.
And this pivot to autonomy is driven by structural labor market failures, right? Not just a desire for flashy new technology.
That's exactly it. The primary bottleneck for any golf course operation today is the labor shortage.
Superintendents just cannot find enough manual laborers willing to clock in at 4 a.m. to mow fairways.
Right. So Toro's autonomous mowers eliminate that labor gap. The machines can be programmed to autonomously manicure fairways in the dark with GPS-guided pinpoint accuracy.
And they're pairing this with their zero-emission FlexForce battery systems, right? So the operation is completely silent.
Yeah, avoiding any noise complaints from the surrounding residential communities.
But the technological leap that stands out most in the Q2 presentation is their terrain AI strategy.
This is fascinating.
They're actively integrating large language models into their core corporate operations.
Specifically focusing on product development, trend identification, and warranty automation.
The warranty automation use case is a massive efficiency multiplier. Tell us about that.
Historically, identifying a systemic mechanical flaw required human analysts to manually read through thousands of warranty claims.
Just stacks of technician notes from dealerships across the globe.
Exactly. Now, they feed those unstructured field notes from a mechanic in Ohio and a dealership in Texas directly into an LLM.
And the AI parses the nuanced conversational text and instantly identifies a pattern, like, say, a recurring microfracture in a specific deck spindle.
Long before a human analyst would spot the trend. So they can isolate the manufacturing defect and adjust the factory line in real time.
Preventing a localized failure from ballooning into a multi-million-dollar global recall. That speed of trend identification protects their operating margins on the back end.
It really does. But if we look at the broader R&D strategy, there is a brilliant leverage model at play.
Yeah. The high-margin professional segment basically funds the bleeding-edge research into autonomous robotics and AI integration.
Exactly. The innovations they develop to flawlessly manicure a championship golf course eventually trickle down into the zero-turn mower sitting in your driveway.
It's like Formula One tech making its way into a family sedan. The massive capital spent developing aerodynamics for F1 racing eventually improves the fuel efficiency of a Honda Civic.
Right. Toro leverages the professional R&D spend across the entire enterprise, giving their consumer products an insurmountable competitive advantage.
So what does this all mean?
It means Toro is an absolute masterclass in balanced portfolio management.
We really have to look past the red plastic of a consumer lawnmower.
Yeah, by straddling the line between consumer goods, professional landscaping, high-tech golf maintenance, and heavy infrastructure, they've engineered a business model that wins in almost any macro environment.
They are largely insulated from singular macroeconomic shocks, supply chain blockades, or localized bad weather seasons.
It really is brilliant corporate architecture.
It is. But I want to leave you, the listener, with a final provocative thought to mull over. Something based on a single line buried in the appendix of this presentation.
Oh, the subscription line.
Yes. Toro explicitly noted that their smart connected products are beginning to drive subscription services.
Which is huge for a legacy hardware company.
Exactly. As a company traditionally known for selling heavy pieces of metal and plastic, what happens to their valuation and business model over the next decade if they transition?
If they move from just selling you a machine in a one-off transaction to charging you a recurring software subscription to make that machine smart.
Right. If they charge a commercial landscaper a recurring software subscription to keep that machine's autonomous navigation and AI diagnostics active, the fundamental nature of the business changes.
It raises an important question. Is the lawnmower of the future really just a software platform on wheels?
If the physical hardware eventually becomes heavily commoditized, the proprietary software operating the machine becomes the ultimate economic moat.
And the companies that secure that software moat early will dictate the next century of manufacturing.
Well said. Thank you for joining us on this custom deep dive into the Toro Company's Q2 financials.
It's been a great discussion.
Keep questioning the fundamental mechanics of the businesses behind the everyday brands around you. You might just find a high-tech logistics empire hiding behind a lawnmower. See you next time.